Hello, Invest with Rules Inner Circle. It's your friend Scott Bennett. Today is April 24th, Wednesday. Welcome to the midweek update. I'm so happy you're here. We are in the heart of earnings season. There's a lot going on. We have some inflation data on Friday, but we're really defensive. I know the market is still within a sell-off, and we'll talk trends of stocks. We'll talk trends of ETFs. We'll talk kind of a concept that I follow of when to stop buying. So I want to talk about that and a whole lot more. Let's dive right in. Here we go. All right. So Wednesday, April 24th, when to stop buying is one of the Q&As I think is really good today. Market trends and my watch list. Before we do, world's quickest disclosure. This is just information. It is not a direct solicitation to go buy or sell anything. Please always manage your financial plan, manage your risk, manage your stops. There's a lot of risk in this market. So try using rules to protect your capital during tough times, and then we'll use the rules to play a lot more offense when the opportunity sets up. If you're having any trouble, or you're missing signals, or there's something on your mind, some feedback for me, please shoot me a note, scott@investwithrules.com. I'd love to hear from you. All right, let's dive in. Here we go. So macro headlines, there's not a lot, but mortgage demand drops mainly because interest rates are now, or the mortgage rate's over 7% on a conventional 30-year fixed rate. So that's pretty rough. So if someone's going to be buying a new home or having to move, you're looking at, I mean, more or less from a few years ago, at double the mortgage rate. So that's a real bite out of your monthly budget. So purchase applications declined as home buyers delayed their purchase decision due to strained affordability and a very low supply, says Joe Kahn, the MBA's deputy chief economist. So this is kind of just spreading through as housing slows, the economy in theory should slow behind it. But in general, what we'll simply look at next is some predictions. I always find this really interesting, whether it's will come true or not. But JP Morgan's Marko Kolanovic says on Monday, he says the correction likely has further to go, adding that the current market narrative patterns are increasingly resembling those of last summer, when the upside inflation surprises and the hawkish Fed revisions drove a correction in risk assets, but investors' positioning now appears more elevated, meaning people have more stocks, they're more susceptible to risk, so they could be more of a bigger hit. He says, strong dollar, higher bond yields, elevated oil prices, and concentration in a few high-flying stock make up a problematic backdrop for equity. So JP Morgan's analyst says, be careful. And then Goldman Sachs tactical specialist Scott Rubner says he also sees further downside. I received the most amount of incoming client questions this weekend in 2024, was asking, was that enough? Meaning, was enough equity exposure reduced last week? And my reply is no. Rubner wrote on clients have been reducing exposure on any green tick. So you're getting JP Morgan, you're getting Goldman Sachs coming out with telling their clientele that there's caution up ahead. So it's really interesting. I know we'll talk about our positioning and our defensive measures, but let's move to the market history. So that was shared to me by client Leanne, so thank you for that. And I saw this this came from Carson Investment Research. So it pretty much looks at when the stocks, after a 5-month winning streak on the S&P 500, what typically happens next is what the data shows. And very simply, what it looks at is, so we're looking at the S&P 500 returns after the win streak, and it shows that typically 1 month, so the win streak's now over, and then the 1 month is typically pretty ugly, and that's kind of what the market's experiencing right now. And then the question is, okay, well, how long is the difficult times? And typically the next 3 months, you're still typically historically down from this type of a really good run. And then when does the reprieve happen? Somewhere in the 3 to 6 month range is what history says. So if we fast forward 6 months, that brings us right to the US election. So just kind of things for food for thought in regards to what the market history tells us after a really good run like we had from October until more recently. So I hope that's kind of interesting and helpful. Again, what we simply do is we follow the trend. We follow the process, and the trend roadmap very simply identifies uptrends, identifies downtrends. So what's it telling us today? Whenever you have a very extended market, the stock market score tends to stay up high pretty long, and we're not that far off of all-time highs. So a 10 is a very strong uptrend. A 0 is a very difficult downtrend. We're at a 7, and we've been kind of ticking down the last several weeks. So we kind of moved down. What are the sectors and the stock market indexes telling us is all the way to the right. The strongest sectors right now are utilities and energy and staples. That should say a lot. That's very defensive. And what's kind of all the way to the left that's experiencing the most amount of weakness: materials, real estate, and tech. So it's really been a really kind of a big rotation out of risk assets, and that's what's going on. Let's move to the level one all-weather portfolio. And this portfolio, very simply, it goes anywhere. It very simply, it looks at stock market indexes. It's either in 4 indexes, or it's in cash, or it's using the inverse of the 4 indexes. So it's designed to play defense when necessary. So right now, it's only 25% exposed to the market. 75% is in cash, earning its 4 to 5% interest rate. So right now, it's a half position in the S&P 500, and it's a half position in the international markets. And you can see the performance all the way to the right is the P&L. And a road tripper, just for grins, is just if we've made more than 3 times our risk unit. So let's say our risk unit is the most we're willing to have suffer is -5%. So if we're up over 15, then we can adjust the stop lower to allow it for more room to run, because that's clearly the strongest horse. And what we're simply doing is we're trying to let our winners run and cut our losers quickly. We are not exposed to the NASDAQ. Right now, the market has given up all of its morning gains. We're not exposed to small caps, and we closed out our hedge of inverse small caps for a very small gain. And we'll talk a little bit about that. But they're all on coast in regards to the hedges. All of the stock indexes are on break signal, so they're in downtrends. This is a difficult market. We are in a more difficult pattern. So I just want to share that with you. Let's rewind. I always follow the trend, but I always have I want to know what my expectations are, what the risk is. So 2 weeks ago, if you go back in the video archive, I was looking at a market to say, okay, well, if there is more risk and this market does pull back, where's the first stop that the bus will take us to? And my thought is that there is a gap that on the S&P 500 was about 3.5% lower. And we know the NASDAQ is down. Last week, it's been pulling back. So we got there. The NASDAQ's down even more than that. It was down almost roughly 7 to 8% from all-time highs. So we kind of expected this. We got this, and we de-risked. Again, we took a half position off of the S&P 500. And then also last week, we said, okay, well, what's my expectation moving forward? And again, we only have a half position. So I said, well, it'd be logical if the market had some sort of a relief rally. That blue line happens to be the 150-day moving average. And then what if we hit it and then roll over hard? Is kind of an expectation that I had that will get us to the middle of the channel. And then last week actually that's this week. So apologize, that's this week. It's up there and it hasn't even got to the 50-day yet, and it's struggling. So apologize, that's this week, and that's kind of where we're at. That's why we have a half position. It could easily roll over and we take off all of our exposure, but that's why we took off half. You can see there's more elevated risk. That's what's going on. So let's look at underneath the hood. So what are the stocks telling us underneath the S&P 500 hood? So again, the S&P 500 is on a break or a downtrend. Microsoft, NVIDIA, Amazon, Meta, Berkshire, Eli Lilly, and JP Morgan, they're all on break signals, meaning they're in downtrends on the short term. Apple is trying its best. It's in a short-term and long-term or a daily and weekly downtrend. So it's been in an awful pattern, but it's trying to find some form of a bottom here. We'll see how it plays. A U-turn, very simply, is it's trying to say that there's a probability that the downtrend might be over, and the downtrend could easily resume down and fade harder, but it will move back to a break to tell us that. Google has earnings, so even though it's on a gas signal, it's always worthy to be cautious before earnings. But you can see how there's just a ton of break signals, and that's why the S&P, the top 10 holdings, are kind of telling us that the overall index is on a break signal. Let's go back in the time machine 2 weeks ago on the international markets. We said a very similar thing. Could it come back down and test support from the 2023 highs? And lo and behold, last week we got there. And then we got that little bounce, which is very similar to the S&P. Again, so far, very weak on weak volume. Again, that's why we only have a half position, because it's kind of in no man's land on this bounce. If it resumes, we'll add exposure. If it fades, then we'll certainly, it could easily move back down to that orange 150-day moving average. Again, we're being cautious. We have a half position. I'm going to move to Bart's great question. So he says, always looking forward to your videos. Thank you for that. Thank you, Bart. He said, in your last video on April 19th, you shift the PSQ from a gas to a coast. So meaning that it went from an uptrend to kind of more of a neutral trend, or it's just extended. I said, I'm a little bit surprised since the NASDAQ lost 6 days in a row, and especially Friday when things went really wrong for some leading stocks. So my question is, how can you explain this change? So just in summary, PSQ is the inverse of tech stocks. So it was telling us, the trend roadmap's saying that you could, in essence, that there's an uptrend betting against the tech stocks. And then eventually it took that uptrend signal and said, be cautious. So, or just in essence, stop buying is kind of the thesis of what the tool is trying to say. So again, mind your own personal risk tolerance. So again, tech stocks are in trouble. It went from a gas to a coast. So here's what a chart of what it looked like. And you can kind of see how it really ripped. PSQ is the inverse of the QQQ or the NASDAQ 100. So there's a problem here. And then what I simply said to Bart, I said, again, thanks for your great question. I said, there's a mechanism within the trend roadmap that indicates when a stock or an ETF is extended, meaning it's gone up so much so that it presents more risk to start or add to a position. So the signal moved from a gas to a coast. So it said, hey, that's enough. And that's what happened. The trend roadmap then waits for a better, lower risk entry point. Again, there's never a low risk entry point. There's a lower risk entry point. So again, it's simply saying, just if you miss that big run, that's when the gas signals were on, then just be patient. It's going to, in theory, pull in and give us more opportunities. So Bart, I hope that's helpful. And again, back to that, what if it goes up and then fades? It'll then flash back to a gas signal again. That's what I'm patiently waiting for. So Bart, great question. I hope that's helpful. I'm going to go one level deeper. So there is a tool in the technical analysis tool belt called Relative Strength Index. And when a relative strength index, we're looking at a weekly chart of the NASDAQ 100. Again, I'm just sharing this with you from a process standpoint. Again, this is the industry speaking. When it's the score at the bottom is over 70, that's kind of extended. And when it's under 30, it's oversold. Again, doesn't matter what the term is, but what I simply did was I boxed in red when it became, in essence, extended. Now, here's something to note is obviously the NASDAQ, when from November's low, it really ripped. So the kind of the easy money's been made, and it could always go higher. Things can always become more extended or more oversold. But you'll notice that it did have that pullback after that red box ended. Same thing happened more recently. It's just simply saying that there's elevated risk and to be more cautious to kind of politely stop hitting the gas signal. Stop hitting the gas. Get your foot off the gas. When it moved to the coast is kind of what it's trying to scream at us. So I hope that's helpful, Bart. That's kind of a mechanism that one could use just to kind of further explain what the trend roadmap's trying its best to do to help us. Let's move to level 2. Level 2 is truly a go anywhere ETF strategy, literally anywhere. Hundreds and hundreds of ETFs looking for uptrends. So as of this morning, it's only 35% exposed, and the rest is remaining in cash. It's currently a gas signal on Chinese tech stocks, which are doing okay today. A coast signal on a basket of commodities and financials that moved to coast today, again, down slightly. Communication services are on a break signal. That's where Netflix and Google and Meta live. So we have a half position there, half position in financials, and half position in industrials. And very simply, what I'm doing is at this point, once we're at a half position, we've de-risked the position. We're using that mental risk alert because we have gains on all these positions. We're just, in essence, using these kind of trailing stop loss mentality to, if the position does go higher, we want to keep locking in more and more of our gains. So that's what I'm watching. I will certainly add more positions that are non-correlated to the market. So I added KWeb We had a half position, so it just went back to a full position yesterday, and so far so good. But in general, what we're trying our best to do is to add non-correlated positions in ETFs when the market's under pressure. So when the market or the S&P 500 or Nasdaq's on a break signal, I am more cautious about adding new positions. What's actually in uptrends right now? Let's talk about that. So right now we have corn, wheat, and we have Chinese tech, KWEB. Let's just look at some charts. So these are really bombed out charts if you look at them on a weekly basis, but here's a daily chart of corn breaking out of a downtrend. Could it kind of come here, sit down on resistance and try to make a run for the 200-day moving average? It's possible. Wheat has already made a big rip. And this is probably one thing that I'm watching. Obviously, when you do trade commodities, physical commodities, you have to experience K1 tax forms. So bear in mind, I'm not a CPA, but always mind that you have some potential tax items at the end of the year if you trade physical commodities. And here's a chart of KWEB, which we are in, and we are holding our position. It would make sense for it to now, what was once resistance could now come back down, sit down as support, and then be a launching pad if the Chinese tech market keeps acting appropriately. Again, these are areas of the market that have already had their polite recession. They're down huge. So this is like we're buying things off the bottom that are in uptrends. Let's move over to the April $1 billion fund manager report. And April's coming to an end soon. So what that means is that we are getting more and more data coming in on roughly $1 trillion. And we're going to share with you what are the big funds buying. What are they buying a ton of shares on? What do they own some of the float? What are they buying large dollars? What are they buying over the last 3 months? We've seen some, even though it's been a really tough month, there's been a lot of action. So spinoff WK Kellogg is actually up 25% this month. Isn't that wild? We own Sea Limited SE, which is up 18 for the month. And there's a couple that are on gas signals I'm watching closely. Again, I'm more cautious when the S&P is on a break signal, but there's a lot of blue off to the far right, meaning that its earnings are within 2 weeks. So it is more a cautious time when it's earnings season. But you can kind of see there has been a lot of there's been a lot of merchandise that has done way better than the S&P 500, and that's where the trend roadmap comes in next to say, okay, well, what are on gas signals, and just always be cautious of earnings. So that's what I'm watching closely. And here's speaking of the $1 billion fund manager report, we are cherry picking stocks as best as we can, called the Follow the Big Money portfolio, or the $1 billion fund manager stock portfolio. And here's what we own at the moment. We have a half position on Airbnb back on a coast signal. A really nice strong earnings reaction to Boston Scientific, up almost 7% today, BSX. We have Walt Disney up 20%. It's on a break signal, so we're using that mental risk alert, trying to hold as long as we can with gains. And we have Sea Limited, which has obviously done quite well since we added that to the level 3 strategy, which is the follow the big money strategy. So watching this, again, only 35% exposed to the market, and the remaining is in cash. We're being more cautious. What's on my watch list in uptrends today? It's not a lot. And I'm going to be cautious again. The market's in a downtrend. So we have Allegro Microsystems, a nice reaction. I assume that's earnings today or some sort of a news-related item, up almost 7%. Obviously, it's been in a difficult downtrend, but breaking out of a trend resistance. So that's on my radar. It gets a C. C means moderate accumulation. It's not huge, but it's a semiconductor that has not experienced the joy of the other semiconductors. And then we have finally Goldman Sachs GS. Goldman Sachs in an uptrend. That's interesting. Obviously, I'd like to see the market act a little bit stronger at this moment. But I think the other thing about Goldman Sachs that's really interesting, it is coming up on a green line breakout. So it would be, if it gets up and over, it would be absolute all-time highs. So it's something to note that Goldman Sachs has had a tough few years in a row, and as the funds are attracted to Goldman Sachs, which receives an A for top accumulation for the last 3 months from my reports. So again, if one has a bigger risk tolerance to go and buy things when the market's in a downtrend, this is what the merchandise looks like. So being cautious, and there's not a lot out there that don't have earnings in the next 2 weeks. All right, so I'm going to stop there. I want to first thank you for your time. Thank you so much for being a member of Invest with Rules. I hope you found this helpful. Again, thank you for your time, and I look forward to connecting with you on Friday. And be careful out there, manage your risk, and we'll talk soon. Thanks. Bye bye.